Good afternoon, everybody. I'll be your moderator for this afternoon. My name is Ina Willemsens. I'm with the Wisconsin Procurement Institute. Who knows what a PTAC is? Okay, good enough that I don't have to tell you about it. But every state has one. If you don't know, approach me afterwards and I'll share some information on the website where you can find your local area PTAC. A couple items. Please take notes of the emergency exit, of which we have one back door. Also, please silence your mobile devices out of respect to the presenter. We want to thank all our sponsors for the SAMI Small Business event. So far, it's been a great day. Look forward to great opportunities and a great presentation coming up. Remember that you can earn 1 PDH by attending this session. Make sure your badge is scanned. If it has not been, please ask at the door and they'll scan your badge for you. This presentation will be available on the SAMI Small Business website, and I believe your assistant is handing out a flash drive that will have the presentation on it. He's to share. Also, if you're not aware, this session is being audio recorded, so take heed. Anyone that asks a question, I'm going to try to restate it for the speaker so that we can all hear the question and the answer. There is a mic in the middle aisle, but the tendency is for people not to necessarily get up and go to the mic, so we'll make that happen. And now let me please introduce Mr. Robert Smith, and he'll be talking about DCAA and accounting issues. Thank you, sir.
Thank you, Ina, for that introduction, and appreciate all of you being here this afternoon. Good afternoon to everybody. What I want to discuss today deals with small business government contractors having what's known as an adequate or otherwise compliant accounting system. And so there's really 4 key points that we want to address, and those 4 are: when does a government contractor have to have a compliant accounting system? What makes up a compliant accounting system? When your accounting system's being audited, what should you expect during an accounting system audit? And finally, where do you go for guidance? So we want to provide some information on all of those. The key area where we'll be spending most of our time in this presentation is going to be on what makes up a compliant accounting system. So I think we do have about 10 minutes at the end for taking questions, but if anyone has a question during the course of the presentation, please feel free to interject and let me know, and I'll do my best to answer it as quickly as I can. All right, so when does a contractor need to have a compliant system? It all centers around contract type. And if you're acquainted with the basic types of contracts, we have fixed price type contracts, we have time and material type contracts, we have cost reimbursement type contracts. Time and material type contracts frequently are simply labor hour contracts. But if there is a material component, that does behave, the material component behaves like a cost reimbursement type contract. And so that's where the cause for a compliant system comes in. And it's all rooted in this particular clause in the Federal Acquisition Regulation. It comes from section 16.301 out of the Federal Acquisition Regulation, which says that a cost reimbursement contract may be used only when the contractor's accounting system is adequate for determining costs applicable to the contract or order. And as I said, it's going to be there for cost reimbursement type contracts and T&M type contracts, which have a cost reimbursement element to them. Now, what makes up a compliant accounting system? You're going to find 2 paths to go down for this, and it's really driven by whether the contractor is subject to the cost accounting standards. Now, given that we're dealing with small businesses, this conference being a small business conference, I would presume that if everyone here is small business, that you're probably exempt from the cost accounting standards, at least from full CAS coverage. So let me just get an idea. Is everybody in here small business? Yeah, I figured as much. Has anyone had to deal with an accounting system audit up to this point? Okay, we got a few. And I presume by you being here, you're probably at least curious as to whether you may be subject to having to deal with this, or maybe you intend to pursue cost reimbursement type contracts to get to that point. So those who are subject to CAS coverage have to deal with what's known as DFARS 252-242-7006C, which lists out a whole litany of criteria for an adequate accounting system. And the audit requirements on that are a little more stringent as well. But for small businesses, it goes the route of what's known as a Standard Form 1408 review, accounting system review. And in that accounting system review, what the contractor basically has to demonstrate is that their accounting system is capable of determining costs on government contracts. Now, here's the interesting thing. The criteria that are listed on the 1408 are almost identical to the criteria in the DFARS provision. It's a little less stringent, though, with respect to the audit standard. So when you have an accounting system audit done with respect to a 1408 set of criteria, all they're doing is determining that your accounting system is capable. If you're subject to a DFARS type audit, it's going to be a little more, or probably a lot more specific in scope and a lot more detailed. So they're going to hold you to a more stringent type audit. But I'm presuming that everybody in here is going the route of 1408 if you have to do that. And by the way, Amy DeBruler of our firm has passed out to everybody a Standard Form 1408. So we're going to spend the rest of our time, or most of the rest of our time, talking about what's on that Standard Form 1408 document. And since you now have a hard copy of it, that might make it a little easier for you to follow along. So we talked about the distinction between the DFARS provision and the Standard Form 1408. And here's what the 1408 looks like. And you all have this in front of you as well. And it's broken out into 5 sections. And the first question deals with whether the accounting system is established in accordance with generally accepted accounting principles. We'll spend about as much time as the auditor spends on that, which is about 45 seconds. And then we're going to get into sections 2 and 3, which are the core components of the accounting system review. And you can see section 2 has items 2A through 2J, and we're going to go through all of those. And then we'll deal with section 3, which is more oriented towards management oversight and control and measuring against expected results and things of that nature. And then questions 4 and 5, the auditor basically does that at the very end of the audit. And there's very little to be done with respect to those elements of it. Once you've satisfied items 1 through 3, you're pretty well done. So, the first section. What they're looking to see is that the contractor's accounting system is established in accordance with generally accepted accounting principles. I know we're all engineers in here, except for me. But from an accounting perspective, what they're looking for is that your system is set up on the accrual method of accounting and that it's a general ledger-based system. That's really as far as they go. They want to see that your system can produce financial reports that are rooted in a general ledger, and they want to know that you're accumulating your costs on the accrual method as opposed to the cash method of accounting. And you may understand with respect to doing tax returns, you're probably on the cash method where you recognize revenues when you collect them, not necessarily when you earn them. and you recognize costs when you incur them, not when you pay them. So it takes the contractor's ability to manipulate the timing out of it, because you're going to record those costs when they're incurred, not when they're either received or paid. But then we get into the next section, and we've got items 2A through 2J here. So let's talk about each one of these, because this is the heart and soul of a compliant accounting system. So the first thing is whether the accounting system segregates direct costs from indirect costs. Well, what are direct costs and what are indirect costs? Well, there are definitions in the Federal Acquisition Regulation with respect to direct and indirect, but you want to understand it like this. Direct costs are entirely variable in nature. If the contract doesn't exist, you are not going to incur that cost. These are costs that arise in specific performance of a contract, statement of work objective of a contract, and they're identified with a single particular final cost objective being a contract. Indirect costs, however, are those costs not directly identified with a single cost objective, but can be supporting multiple cost objectives or could be administrative in nature. So the idea there is that you're going to accumulate the indirect costs and then allocate the indirect costs amongst the cost objectives using some sort of an allocation-based methodology for spreading those costs. So direct costs get assigned to a single cost objective. Indirect are those that are accumulated in a pool and then are spread or shared or, in effect, allocated amongst your contracts. Now, how do you make that happen in your accounting system? Well, it's essentially done by the way you organize your chart of accounts. So when a contractor, a government contractor, is organizing its chart of accounts, it's going to have a grouping of accounts that are headed up by a label for direct costs. So your direct labor will be an account, your direct subcontractors will be an account, your direct materials will be an account, and so on. And they will all be in a particular group that you're going to identify as direct costs. But then you can have multiple indirect cost pools. A common configuration would be what we're showing here, where you could have a grouping for fringe, a grouping for facilities, a grouping for overhead, a grouping for G&A. But I want to emphasize that this is a way, not necessarily the way, of organizing an indirect cost pool structure. And what you'll want to do is organize based on what is right for your business. I have seen small businesses that have just a single grouping for indirect costs, and they don't specify what's fringe or overhead or G&A. They just have a single indirect cost grouping. And if it's a small business, DCA is probably perfectly fine with that. I've seen others where they have a separate grouping for fringe and then a single grouping to consist of anything other than fringe. Fringe typically being the costs of having employees. So it could be your compensated absences, your group benefits, and your payroll taxes being in a fringe grouping. And then you could have a separate pool for indirect, which would consist of anything that's overhead or G&A. And then I've seen many contractors who have much more complex configurations where you can have multiple overheads. Maybe you have different locations, so you have an overhead for multiple locations. It's not uncommon to see a contractor having a company site overhead and a customer site overhead. Or maybe you have overhead for location A, location B, location C. So this is an example of a way of organizing your indirect cost pools. However, as long as you have logical business reasons for having a particular indirect cost pool structure, DCA is not going to argue with you over that. Now, once you've segregated your direct from your indirect, we're going to move on to the next item on the checklist, which requires that the accounting system identify and accumulate direct costs by contract. Well, what does that mean? It means that your accounting system must have a job cost capability, where when you assign a cost to a direct cost element, such as direct labor or direct materials or direct subcontract, you're also going to identify it to a particular contract. So the accounting system has to have a job cost capability. Each cost item incurred in specific performance of the contract shall be assigned not only to a cost element, an account, a direct cost account, but also to a contract. And the accounting system then needs to be able to summarize the direct costs by individual contract. So here's what that might look like, where we have the cost elements going down the side, direct costs for direct labor, subcontract, and so on. And then you can have a column for each of the individual contracts, and then you can see how much direct cost there is assigned to each contract. And then, of course, at the end there, we have a total column. And what you then want to make certain of is that that total column reconciles to the corresponding account balances in the general ledger. So if we are taking a look at this detail and we see $1,550,000 of direct labor on this contract cost report, we want to go to the general ledger and see that the balance for direct labor is $1,550,000. I can give an example out of QuickBooks, for example, because I know many small businesses will use that. It's entirely possible to assign a cost to a direct cost account and fail to assign it to a contract. So as an internal control, at the end of each accounting cycle, typically monthly, you want to run the job cost detail and make sure that it agrees back to your general ledger. And so that's how we get to this, satisfying this requirement of identifying and accumulating direct costs by contract. Now, we talked about the direct costs. Let me come back up here. You notice that we're showing a total for direct costs here. This doesn't take into account the indirect costs. So what do we have to do about indirect? Well, the third item in Section 2, item 2C, requires that the accounting system provide for a logical and consistent method for the allocation of indirect costs to intermediate and final cost objectives. Now, let me just pause there for a moment. Final cost objective being a contract. An intermediate cost objective will be another indirect cost pool. And as we take a look at these slides that I'm going to show as illustrations, I'll be able to illustrate that particular point a little bit more. But the point being that we have to have established in policy what is in your cost pools and what are in your allocation basis. Because when an auditor comes out to look at that, they want to know that not only are you doing it logically, but that you're maintaining consistency in how you do it accounting cycle, across your accounting cycles. So you can't do it one way this month and a different way next month because you get a little more favorable result if you change your pools and bases around. DCAA doesn't want to see you doing that. You have to establish in policy what your indirect cost allocation methodology is. All right, so the way that it's done then is by use of what's known as indirect rates. And indirect rates are, in effect, the resulting ratio by dividing your cost pool by your allocation base. So if someone were to ask you your overhead rate, that, in effect, is the rate at which you're going to apply overhead to each contract's share of the allocation base. And we'll illustrate that here momentarily. So here's what a typical fringe pool could look like, where we have compensated absence amounts, we have some group benefit costs, and we have some payroll tax costs here. And we can see the total fringe pool being this pool components number. We have about $578,000 there. The allocation base for fringe in this example are our labor costs, and that's fairly typical. Now, our labor costs consist not only of direct labor, but also various indirect labors. In this example, we have overhead labor, we have G&A labor, we have bid and proposal labor. So, we talked about final allocations and intermediate allocations a minute ago. Here, the amount of fringe allocated to the direct labor is going to go to the contracts. And when I show a contract cost report again, take note of this number for fringe. It's $461,380. We're going to look for that number when we look at the contract cost report. But that's the amount of fringe going to the contracts. The amount of fringe on the overhead labor, that's going to flow into and become part of the overhead pool. So that's an intermediate allocation. And then the amount of fringe on the G&A labor and the bid and proposal labor, those two accounts are contained within the G&A pool. So the fringe on those two labors will flow into and become part of the G&A pool. So those are also intermediate allocations. So in this example, out of this total fringe amount of $578,000, $461,000 is a final allocation going to the contracts. These others are intermediate allocations which flow into and become part of those cost pools, which will then be allocated. So now we're looking at the overhead pool. Now, when we look at the overhead pool, we see the total overhead coming from our general ledger system is this $390,000 number. Now, I didn't do a slide for the facilities, but the facilities is strictly intermediate in nature in that those are costs that are being allocated, they're accumulated in a facilities pool, and then they're shared between the overhead and G&A. But that's an intermediate allocation. And then we do see the fringe allocation on the overhead labor coming into the overhead pool. So then that gets us the total pool component. And then here's our allocation base. And again, the pool detail and the base detail are all written into policy, so you should have written policy and procedure statements so that we're doing it in a consistent manner across accounting cycles. And then we see our overhead rate there at the bottom. And now we look at the G&A and we see the same thing. We have what's coming in from the general ledger. We have a facilities allocation. So up here, these are all our intermediate allocations. And then this is the base. And so the G&A pool in the aggregate will all go to the contracts unless there's an unallowable element in the base. Now, here we're looking at a contract cost report. And recall that we already showed the direct costs going out to the contracts, but I pointed out in that previous slide that we didn't have the allocation of the indirect. Well, here we have the allocation of the indirect. And remember that fringe number that we talked about? The fringe on the direct labor is what's going to the contracts. And how much goes to each contract? Well, that depends on the amount of direct labor on each contract. So once we've determined our fringe rate, we're then applying that to that contract share of the allocation base. And in the fringe example, the allocation base is the direct labor. Now, the same holds true with these others, and given that I have only 50 minutes to talk about this, I kind of have to rush through this because I could do this same presentation in 5 hours as opposed to 50 minutes. But anyway, if we wanted to break all this out, I could trace all these numbers back from those cost pool examples that I showed in the previous slides. And by the way, since you have the slides, you all get to do that on your own time. But anyway, that's what's happening. So the idea here is we're identifying and accumulating the direct costs by contract, and then we have a logical and consistent method for the allocation of the indirect costs amongst the contracts. So that's what the auditor is looking to see when they're evaluating your accounting system. Does your system segregate the direct from the indirect? Does your system have a job cost capability for identifying and accumulating the direct costs by contract? Does your system provide for a logical and consistently applied methodology for allocating the indirect costs amongst the contracts? Once you get past that part of it, now they're still going to hit timekeeping pretty hard, and we're going to talk about that in a minute, but then they're going to go to this next piece where they're going to want to reconcile that job cost detail back to your general ledger. They want to know that you're accumulating these costs under general ledger control. So if we come back to this slide, remember we talked about how this total column, and you're looking at the direct costs, that you need to make sure that this job cost detail reconciles back to the general ledger accounts. Well, for the indirect, we know that if you look at the fringe that's being allocated out amongst the contracts, that will not agree to the fringe pool. Remember, only the fringe on the direct labor goes to the contracts. But the fringe on the other base elements, the overhead labor, the G&A labor, and whatever other labors you may have, they're receiving fringe allocations too. So what's happening is some of the fringe goes to the contracts, some of the fringe goes into the other cost pools. So if you were to try to look at the fringe that's allocated to the contracts, it's not going to tie back to the ledger directly like that. But what is going to tie back is the total indirect cost, the total indirect costs being allocated. So if you were to take this number, you'd be able to reconcile that back to the general ledger. Now, there may be a reconciling item for unallowable, but you'd be able to readily identify that. But you want to be able to know that the indirect costs allocated out to your contracts can tie back to your ledger, and the auditor is going to want to know the same thing. So they're going to want to make sure that all your job cost detail agrees back to your general ledger. So what they'll do is they'll look at the direct cost elements, they're going to look at the total of the indirect costs, and they want to then conclude that contract costs are accumulated under general ledger control. And that's item 2D on your standard form 1408 document. All right, the next thing is timekeeping. They will hit timekeeping very hard. And they will always ask you for a copy of your timekeeping policy. If you ever meet a DCAA auditor, you may as well just hand them your timekeeping policy. They're always going to ask for it. They'll probably ask for many of these others, but they'll always ask for your timekeeping. Now, where are you going to find guidance with respect to what you have to do for timekeeping? Because, interestingly, the Federal Acquisition Regulation doesn't say anything about it. Where you'll find guidance is from DCAA's website, where they put out a publication on there called Information for Contractors. And in that publication, by the way, it's on your flash drive, right? In that publication, Enclosure 2, which is like Chapter 2, discusses this Standard Form 1408 criteria, and they have several pages on what makes up an adequate timekeeping system. The second place you can look for guidance is in the DCAA Contract Audit Manual, and in there, they'll give you guidance on what the auditors look for when they're evaluating a timekeeping system. Now, when you're looking at the DCAA publication, there's 5 core areas with respect to timekeeping. There's timekeeping procedures, there's timekeeping preparation, there is a recommended timekeeping policy. Now, what they do is they give you various paragraphs on certain subject matter and recommend that you include those in your timekeeping policy. It's not intended to just be a cut and paste type thing, but you should have what they provide addressed in your timekeeping policy statement in some manner. And then they talk about labor floor checks or interviews. And this is what they do to come out and check on your timekeeping system. Whenever DCAA is coming out to conduct any kind of an audit or a visit to look at anything, they're always going to notify you ahead of time by sending you a letter or making a phone call, schedule it with you, make sure it's an acceptable time for you, and perhaps be willing to reschedule, except for this particular type. The labor floor check is a surprise visit. They show up unannounced. Has anybody had to deal with one of those? A couple of you have. Okay, so you know what I'm talking about. They just pop in and say, "Hi, we're from DCAA, and we're here to help." They're wanting to, number one, make sure that the employees are completing their own timesheets. They want to know that the employees are filling their timesheets out on a daily basis. They'll want to make sure that the labor that is reported on timesheets or the labor that's being billed on contracts can be reconciled back to timesheets. And one of the things they'll want to look at is to make sure that the labor for individuals that are being billed are actually on your payroll, actually exist. Because believe it or not, they have found examples where someone's being billed in October when they were terminated in July. So they're going to want to make sure that the amounts being billed are supported by timesheet documentation that's accumulated under an adequate timekeeping system. And then finally, they give you some information with respect to the penalties for labor mischarging. All right, now with respect to the DCAA audit manual on timekeeping, they've got two sections there. One dealing with the audit objectives for a manual timekeeping system, and here's something that's evolved in recent years, and actually now it's approaching 20, is audit objectives for automated timekeeping systems. I am a huge proponent personally of web-based timekeeping systems because the internal controls are far easier for a contractor to maintain and oversee. You can program things like alerts that go to employees if they fail to update their timesheet that you just can't do in a manual timekeeping system, you know, the old pen and ink methodology. So, for example, if an employee fails to enter time at the end of a particular day or by, you know, whatever demarcation point, 10 a.m. the following day or whatever it is, the system will send an alert to the employee reminding them, hey, fill out your timesheet. If the timesheet goes unfilled, say by a second demarcation point, maybe noon or later that afternoon or something, then the alert can go to the employee's supervisor as well, and so on until it's satisfied. So it really enables the contractor to maintain a stronger level of oversight over the timekeeping system. And it also cuts down on errors because I could reel off a half dozen different web-based timekeeping systems that my clients have worked with over the years. And all of them have the ability to integrate with various accounting systems. So you can, in effect, accumulate the time data in a web-based application and import that time data into your accounting system for the purposes of then using that time data to distribute your labor costs. So I think web-based timekeeping is a very important thing, which that, by the way, then brings us to the next item on the checklist, which is you need to have a labor distribution capability in your accounting system that charges the direct and indirect labor to the appropriate cost objectives. What they want to know is that the charging of labor costs is rooted in the time data that's accumulated in an adequate timekeeping system. So the contractor needs to be able to demonstrate that you have a process for recording and distributing labor costs based on the timesheet data. You have to be able to demonstrate that your labor costs can be reconciled to payroll records and labor costs can be traced to the timesheet source. So if they were to look at a labor distribution, they would be able to see the various entries and they could then trace that back to a particular timesheet. So here's an example of what a labor distribution report could typically look like. And by the way, full disclosure, the indirect side of that, we didn't have enough room to fit the entire report on there. So if you're going to look at the total there, it's not going to add up. There's things that are truncated out of there. However, the point being that the direct labor piece is going to be organized by individual contract. So for a particular payroll cycle, we can see the various jobs, and we can see who, and we can see their various billable labor categories, and we can see how many hours, and we can see the labor cost. So if we wanted to then go and look at timesheet data, we would pull the timesheets for this particular individual, and we would be able to see that the timesheets support that number of hours for that particular person during that time period. And that's important for billing because the billing should be coming from the labor distribution. So you need to have that audit trail from timesheet through to the accounting system and the labor distribution capability, and then on to the invoicing of the customer. So if you look at the hours billed for a senior programmer on the invoice, you should be able to trace that back through the accounting system and to the timesheet. And if it's a T&M type contract, you're only going to be able to see the hours. But if it is a cost reimbursement type contract, you're going to see not only the hours, but also the labor costs, because you're billing costs on a cost reimbursement type contract. So anyway, that's what a labor distribution system, in effect, is going to produce. Now, the next thing on the checklist, item 2G, states that the accounting system must provide for interim, at least monthly, determination of costs charged to a contract through the routine posting of the books of account. The good news on this is, if you're doing everything else that we've just talked about, this happens naturally. This is a byproduct of the other things that you've configured into your accounting system. So you're going to be able to produce contract reports that will reconcile back to the general ledger. And recall that we were just doing that. We just looked at a contract cost report where it showed the direct costs out to the jobs, the allocation of the indirect. We looked at the direct labor on the jobs, and we would be able to then trace that direct labor back through the labor distribution process and actually back to timesheets. So if you're doing those previous things that we just discussed, then you're going to satisfy this requirement simply as a byproduct of having done everything else. All right, now, the next thing on the checklist deals with allowability of costs. And the auditors will want to know that you're proactive in your policies and procedures with respect to excluding amounts which are deemed unallowable from any direct cost or indirect cost pools that ultimately get billed. So, what they want to know is that you have an understanding of what makes up unallowable costs. Is everybody, you've had some familiarity with allowability of costs? All right, so what they're looking for, there's in the publication, and this, by the way, comes right from the Federal Acquisition Regulation, Part 31.2. There are 5 factors in determining allowability. The first one is reasonableness. Now, reasonableness is a rather subjective criteria, because what might seem reasonable to the contractor might be unreasonable to the auditor. But they give us a little more guidance on reasonableness, so we'll talk briefly about that. But then you have allocability. Is the cost related to contracts either as a direct cost or an indirect cost that has some reason for being allocated amongst the contracts? Then they'll look at standards promulgated by the Cost Accounting Standards Board, if applicable, otherwise based on generally accepted accounting principles. Now, we did talk briefly at the beginning about cost accounting standards. Small businesses have an exemption from the cost accounting standards. So if we're all small businesses here, you probably don't have to be worried about that one. The next thing they want to look at are terms of the contract. Is the cost being accumulated consistent with the terms of the contract? If you've got costs, if you've got a contract where you're engaged to design rockets and you're charging costs for designing ships, that cost is not allocable to the contract. It's not consistent with the terms of the contract. So the costs have to be consistent with the terms of the contract. And then finally, the fifth thing is any limitations set forth in subpart FAR 31.205. Now, FAR 31.205 has 52 subsections. And in that area of the FAR, they discuss what they call selected costs. There's a bunch of different cost categories which they then go into greater detail with respect to allowability. A lot of those cost areas are essentially shades of gray. They can be allowable in some circumstances, unallowable in other circumstances, subject to interpretation. So what you as a contractor need to know are, what are the types of costs that are commonly deemed unallowable? So you get a familiarity by looking through this. There are some costs in that area, in that section, which are expressly unallowable, always. There are no circumstances when they're allowable. For example, bad debt. If you have customers that don't pay their bills, you don't get to throw that in your indirect cost pool and have it allocated amongst your contracts and then in effect have the government reimburse you for bad debts. Other things, cost of alcoholic beverages. There's a one-sentence statement in that section. Cost of alcoholic beverages are unallowable. There's no room for interpretation there. So in your meals and entertainment costs, make sure that you flag that and exclude it. The auditors, they go through your meal and entertainment expense reports. If they're doing an incurred cost audit, they're going to be looking primarily at the executives, but also at the project managers and anyone who runs up significant travel and entertainment expenses. Those expense reports are going to get looked at. So you want to make sure you're flagging those. But really what they want to know in an accounting system audit is, do you have an awareness as a contractor of the types of costs that are unallowable, and do you have procedures in place to flag those costs and exclude them or identify them as unallowable? Now, we were talking, here, let me go back to this slide for a moment. The kind of things that they'll want to know, they'll look at your chart of accounts. Perhaps you should have a separate grouping. Remember how we have groupings for fringe and overhead and G&A? You can have a grouping for unallowable costs there. Interest expense, unallowable. Advertising costs, in most circumstances, unallowable. There are some exceptions to that rule, and so on. But if you can demonstrate to the auditor, one, that you have an awareness of what the Federal Acquisition Regulation says is unallowable, and two, that you are flagging and properly classifying unallowable costs, then they'll be okay with respect to item 2H on that checklist. Now, the next two line items here deal with identifying costs by contract line item and units if required by the proposed contract. Item 2I is really taking item 2B. Remember, item 2B being you must identify and accumulate your direct costs by contract. Item 2I just takes it out to a more granular level. Perhaps you have to identify and accumulate direct costs to a task or a contract line item number, otherwise known as a CLIN. Or if you're in a manufacturing or assembly type process, that you can track costs down to the unit of production level. And then the last thing, item 2J, DCAA gives us very little guidance on that. And all they say is that the contractor must demonstrate that they can track costs in this manner. Thanks for the help, guys. They give you no guidance at all. But what they're addressing there is if you have a manufacturing or assembly operation, that your setup of the production line or assembly line is segregated from the actual costs of doing the assembly or production. All right. The next area on the checklist is section 3. And this section deals more with proper oversight of really how you're billing contracts. When the government refers to costs, they're oftentimes referring to their costs, not necessarily your costs. And their cost is your billing item, your revenue. So what they're looking for there, we have two things that we're looking at. Item 3A deals with accounting system provides financial information required by contract clauses concerning limitation of cost or limitation on payments. They want to know that you're tracking the cumulative amounts billed against the funding limitation of the contract so that you don't end up overbilling the contract or billing in, having cost overruns or billing in excess of contract funding. So in effect, they want to know that you track the total accumulated billings against the funding limitation. And many, really, I think all contracts require that the contractor notify the contracting officer once you've reached a certain threshold of billing against the funded amount. So you have to have a capability. A lot of times this is done by virtue of the invoice document that the contractor prepares. But you can also build it into certain reports within your system, as I'll demonstrate momentarily. The next thing deals with the accounting system provides financial information required to support requests for progress payments. Well, progress payment, in effect, is a monthly billing, or an interim billing. Could be every 2 weeks or whatever frequency you have. But they want to know that your accounting system accumulates the detail that you then put on your billings. Now, I mentioned what these types of reports could look like. So here, we're showing that we're tracking the inception to date amounts being billed against the funded value and against the contract value, and we're tracking the percentages of each of these thresholds that have been utilized and percentages remaining. So your system needs to be able to do that. Whether you're doing that on the invoice document, I've seen oftentimes where a contractor will say, well, here's our billings, and up there at the top we're showing the funded value, and we're showing here an accumulated cumulative total for what we billed, and you can compare one against the other. And so there you're satisfying that requirement as well. Now, when we get to questions 4 and 5 on the Standard Form 1408, we're effectively done, because the DCAA accounting system audit program, which, by the way, is on your flash drive, and auditors work based on an audit program or a checklist. It's not just the Standard Form 1408. They have audit procedures. And their audit procedure for this line item here is very simply, the auditor must make a judgment based on whether there is adequate, reliable data for use in pricing follow-on acquisitions. There's nothing that the contractor needs to do to satisfy this requirement. If the contractor satisfied all the previous requirements we've dealt with, the answer to this, in effect, is a yes. The contractor doesn't need to do anything in particular with respect to this requirement. Now, follow-on acquisition. What does that mean? Well, in effect, a follow-on acquisition would be where it's a non-competitive award to the incumbent contractor. They're not supposed to do that, but they do it. They'll award a continuation of a contract without a competitive bid process on occasion. And then the final thing there is whether the accounting system is currently in full operation. If you're new to the cost reimbursement game, all you've done is fixed price contracts or commercial contracts, you've never had a requirement, what you can do is you can have an accounting system and policies and procedures ready to be deployed, but you don't have any background, you don't have any history. So how are they going to audit based on that? So what they'll do is they'll evaluate your accounting system, and then in evaluating the accounting system, they'll make a determination subject to a follow-up audit. So they may make a preliminary determination, and then they'll come back and visit you in 6 months and have a follow-up to make sure your accounting system's operating as intended. All right, now, what to expect in an audit? As I mentioned, DCAA on their website provides an audit program library, in effect. And there is a particular audit program, and they're listed with codes, activity codes. So the activity code is 17740. So if you're going to go to the DCAA website and look at their directory of audit programs, you could find this. This is the audit for what they call pre-award survey of prospective contractor accounting system. That is a standard form 1408 audit. And by the way, we've included that on your flash drive. So you can read through that audit program and get an idea of what an auditor is going to be looking at when they come in to evaluate your accounting system. And then finally, where do you go for guidance? Well, the DCAA website is a great resource. It's www.dcaa.mil, and they have the standard form 1408. You can get that there. You can get that publication called Information for Contractors. You can get the audit program, and you can also find the contract audit manual there. So the DCAA website is an excellent resource. And I think if you're doing business with the federal government, you should have familiarity with that DCAA website. All right. That's all I have, and I think I'm right on time. I've gone a minute over, right? Okay, good. So I'm open to Q&A here at this point. Yes?
You talked about the electronic timekeeping. Can you talk a minute about the need for electronic expense reporting as well, as it relates to some of the things that I've seen, especially people who are new to government contracting, get themselves into difficulty when they don't follow the per diem rules?
Well, just as a web-based timekeeping system provides for better control, better internal control, and requiring employees to follow procedures and reminders and whatnot, so do the expense reporting capabilities. And these expense reporting capabilities are much newer than the timekeeping, although most of the companies, the providers of web-based timekeeping have realized that, hey, we need to provide the expense reporting capabilities as well. And so they can build per diem. I've seen some excellent systems where they have per diem charts built right in. And so you can determine right from that system. And you can do things like take a photo of your expense and then hit the app and go and classify that expense, and it goes right into the system. So I don't really know enough about those expense reporting systems other than a familiarity, probably not much greater than yours, other than from an accountant's perspective. Okay, excellent. I am an advocate of automation. And if it's a system that provides for those kinds of controls, the employees need all the help they can get, because these people are engineers or IT professionals or subject matter experts of various sorts. They're more concerned with doing a good job on the work that they do. And all these ancillary requirements are burdensome. So we want to relieve them of some of the burdens and make these things easier. And these kinds of web-based systems, I think, really go a long way to making it easier for the employees to number one, accumulate their costs onto proper expense reporting systems, and to provide the documentation, and to be aware of what their per diem limitations are. So, great. Yes?
Are there firms that can perform like a pre-DCAA audit for you to see where you actually stand?
Those would be CPA firms, and the accounting profession has certain rules about providing attestation. And you may recall back to the Enron days where Arthur Andersen got in big trouble for not doing good, thorough jobs on their audits. So the accounting profession has implemented much more stringent rules on what accounting firms can do. And so it's not simply having a CPA license being adequate anymore. You have to have what's known as an attest license to make such an attestation. So if you're going to engage a CPA firm to conduct an independent review, then they would issue a report, and that report falls under the audit reporting rules. It's an attestation engagement. And so CPA firms would be the ones to do that. And by the way, more and more, you're seeing where the RFPs, or the solicitations, allow contractors to utilize independent CPA firms to evaluate the accounting systems. It used to be that they only wanted DCAA to do it. Well, that's great, except DCAA is so overwhelmed that they can't keep up with the workload, and so more and more DCAA is allowing for engaging CPA firms, and there's actually GSA capability where CPAs can get awarded under GSA schedule, and they can do things like accounting system audits, they can do incurred cost proposal audits, things of that nature. So yeah, CPAs would be, that's the only area. And by the way, DCAA will not come out at a contractor's request. They will come out at a contracting officer's request because their budget has to be paid for, so usually it's an interagency budget transfer issue. If you want DCAA to audit your accounting system, you can't just call them up. But if you want that kind of seal of approval, you can engage a CPA firm to do that. That doesn't necessarily mean that the contracting officer will accept it, but perhaps the prime contractors, if they're looking at subcontractors, if you can demonstrate to a prime that you have your accounting house in order by virtue of an independent audit of your accounting system, that might put you in better favor with the prime contractors that you want to do business with.
So I see your CPA, I assume that your firm can do this.
Actually, no. I don't maintain the attest license because I'm on the side of the contractor. I'm in the business of preparing contractors for this kind of audit. I am a consultant to organize your accounting systems. So I can't audit my own work. It has to be independent. So I don't maintain an attest license. I maintain a CPA license, but I don't maintain an attest license.
So where would you find a list of these folks that could do that?
You could go to the State Board of Accountancy website for your state, and you'll find it there.
Mizan Rashid with Alden Lab. We are a small, not small business, but outside the limit of 15 million. But what is we have difficulty, like DCAA they don't audit a firm that small. So.
Well, actually they will. There's a multitude of different types of audits, by the way. So if we're talking about audit, you're talking about an accounting system audit?
Yes, because because the different district, we are doing contracting and they're asking for DCAA audited rate, overhead rate, and then we have a CPA doing our independent, review of our accounting. So we have a rate, but that is not DCAA audited. And we have contacted DCAA, probably contracting officer also told that the size of your company, that they are not recommending us, for doing a DCAA audit.
Okay, that's not an accounting system audit. You're talking about an indirect rate audit, right?
Yes.
Okay. That is typically
overhead rate, like all combination of all three.
Right. So that can be driven by contract type, and it can also be driven by contracting officer preference. It's not necessarily they might have brushed you off by saying, your firm's too small, but that's not necessarily true. Okay. The DCAA will come out at the request of a contracting officer. That's the only time they will come out. So if you want DCAA to come out, you don't call DCAA. You have a conversation with your customer and tell them that, it would be helpful if DCA could come out and do the audit. Otherwise, do you accept my CPA's audit report? But yeah, it's not driven by by contractor size. It's driven by type of contract. Fixed price contracts, they'll do their due diligence on the front end prior to the award of the contract. Cost reimbursement contracts, they're going to be interested as to whether your accounting system is capable of accumulating the costs, and then you're going to have to do a final indirect cost rate proposal, otherwise known as an incurred cost proposal, and that's an annual requirement. And again, that's driven by contract type, whether that requirement exists. Certainly.
Sure, make me get up and walk back here again.
Again, it's very specific to your organization. I know you provide some software
Yes.
that helps people do their indirect rates.
Yes.
And so if contractor A uses that software and goes through a successful audit, does that imply that contractor B would be successful as well?
I would really love to tell you yes on that, but the answer is no. They will evaluate a particular contractor's system. It doesn't matter what software you're using. They want to know how you have your internal controls organized. Are you closing your books every month? Are you reconciling your detail back to your general ledger balances? There's a whole litany of internal controls that could be a significant variable from contractor A to contractor B.
I'll take it.
How does this play out with civilian agencies that aren't part of DoD? Thinking Department of Transportation,
Yeah.
Department of Energy,
Yeah.
and maybe
Well-
also some grants under NIH.
Yeah. Well, NIH has their own internal audit capability. And I know that DCAA has provided services to the civilian agencies over the years, but when they get significantly backlogged, then they cut back. And so those civilian agencies, if they don't have their own audit capabilities, their own audit staff to go out and do these kinds of things, because it's all driven by the same set of regulations. It's all the Federal Acquisition Regulation. Now, the various agencies, the Federal Acquisition Regulation has the Defense Federal Acquisition Regulation Supplement, the DFARS, and recall we talked about the DFARS 25224270006, that being the kind of parallel set of criteria to what's on the standard form 1408. But other agencies have similar sub-agency regulations, the way that DFARS is to the Federal Acquisition Regulation. The civilian agencies, if they aren't using DCAA's services, which many of them will, if DCAA makes themselves available, if they're not using DCAA and they also don't have their own audit function to go out and do these things, they'll probably tell you to engage a CPA firm to do those kinds of audits.
Thank you.